Good morning, everybody. I just wanted to take a quick moment to address the bank issue that we're seeing right now with Silicon Valley Bank, to give you an idea of what we're seeing out there and actually how it has an impact on you. So Silicon Valley Bank is a bank that's was set up in California. It's been around for quite some time. Mainly what it does is focus on venture capital and private equity-based companies, specifically in technology, life sciences, and healthcare. They manage around 211 billion in assets and have deposits about 190 billion dollars as of December 31st, 2022. So what happened that I think is really important here is since 2019, this company has tripled in size. And as a business owner, what I know about businesses is if your business grows that much, your systems need to be totally revamped. And from a banking standpoint, the protections that you need on companies that have tripled are basically substantially greater than where you were previously. And I think some of that stuff didn't happen. As the money came into this organization, one of the things they did is invested into long duration treasuries. About 57% of the money were in government debt and long duration treasuries. Over the past year, as everybody is aware, interest rates have been rising. And when there was a run on the bank, what happened is they had to sell these assets at a discount. As interest rates rise, bond prices fall, and that's exactly what happened here. And they had to sell these things at a discount in order to be able to have liquidity for some of the people. So the first thing that I always say, and how this relates to every one of us, is that we always need to protect our liquidity as a business or as an individual. Always make sure that you have a plan A, plan B, plan C, and plan D, because plan A never works. They had one plan here and it was not constructed well, and that's the issues that we're seeing right now. So what they try to do to put a Band-Aid on this was raise more capital by issuing more stock, and they tried doing that last week. Now, one of the things I would tell you is I would never buy stock in a business that basically is going through these types of issues. There's a saying in financial services, which is don't try to grab a falling knife, and that's exactly what was happening here. As this happened, a lot of the investors that had people who had money in these banks, larger deposited, asked to get their money back, which then made this situation even worse. Now, what's happened is that in a joint statement from Yellen, Powell, and the FDIC chair, basically they are going to support assets in excess of the $250,000 of coverage that FDIC has. Normally what happens per account is you're insured up to $250,000. One point I would make for all of you, if you have more money than that in the bank, is you divide the accounts up. So if I'm married, I have an account in my name, I have an account in my wife's name, and I have an account in both of our names, which gives us 3 times the level of protection. And if you need more than that, there's ways that we could structure it. So maybe even using another bank, we have these assets protected. Okay, so I think the biggest things that we're saying here is that the government has said that they're going to back up these assets. And what's very surprising in the market today, which I thought would be down big time, I'm seeing all green so far today, which is very positive. I think the market's responding very well for this. Now, one of the things that I think that concerns me going forward is that many people are saying, well, I should probably just have all my money at the big banks. And I have mixed feelings on that, and let me tell you why. I think the smaller banks, the reason why this bank existed is because many of the services businesses need were not being provided by the big banks. They couldn't get the financing and the different types of banking services they needed through the traditional big banks. And that's what created this opportunity. And I think also that the big banks are more competitive in terms of pricing and services because of the competition that they're getting from small to mid-sized banks. And that's really important. I also think that, again, the banks, if we take a look at this versus 2008, the banks are much better capitalized than they were back then. There used to be these things called liar loans where you could pretty much tell a bank anything you want and you get a mortgage. That doesn't exist anymore. And I've actually had clients go through the mortgage process recently and were blown away with how many steps they had to go to or how much they could actually qualify for. And these are people with good credit ratings. So I think what to do now is, number one, stay calm. Don't make radical decisions because of what's happening out there. Number two, review your banking. If you have more than $250,000 in a banking account, think about doing what we just talked about. If you're married, have your spouse and yourself on one, have you on another, have your spouse on the third. That protects 3 times the amount of assets. Now, what we're going to do is we're going to continue to look at this, and we're going to see what the impact is and where the opportunities are. For the most part, in the duration of the bonds that we've had, we've been short duration for quite a long period of time, simply because I was concerned about what happens to the price of bonds when interest rates rise. And as you could see last year, it had a big impact on the market, and we're going to continue to monitor that. Number two, we are diversified. Again, one of the things that you see as you go through this is a lot of times people choose a single strategy, and their goal is that this is a good strategy, let's put all our money in there. Every dog has their day, and I want to make sure that when we do this, we're spread out. So when there are these issues that impact the financial services business, that we're diversified and we have money that works in different ways. And number three, one of the things that we've been doing too is that staying short and being in money market accounts that have very low durations or very secure and continue to go. So the bottom line is we're aware of this. We're following up on this. We're going to do whatever we can to make sure that your money is protected. I feel very comfortable with Schwab as a custodian, and I think for the most part, a lot of these things should be taken care of within a period of time. It seems like the federal government is backing up these institutions and making sure that their obligations are being taken care of, which is incredibly important. And I think going forward, we probably have to take a look at how banks are working within a small and mid-sized market to make sure they're financially secure, they're still competitive, and they're offering competition against the big banks. That's it for now. If you have any questions, please feel free to reach out and give me a call. Thanks again for your time. I do appreciate it.